Hi, I'm Alex Robertson, one of the co-founders of Real Estate Wealth Development. We are here to help you accelerate your journey to generational wealth through property. So, I spoke in my last video that we're going to do a bit of a tax series. This is episode 1, and for episode 1 in this tax series, what we're going to be talking about is one of the most important distinctions you can make when you're talking about tax within property. And that is the difference between property investing and property trading. And most people don't think about this when they start, but it's really important to understand which side of this that you fall on, whether you're a property investor or whether you're a property trader. And the reason why that distinction is important is because the tax rules are very, very different. And so many people will go ahead with an investment and then not fully understand what the tax implications are because they haven't understood the first step, which is to know which side of this you are on. So, broadly speaking, property investors, they buy property to hold it for the long term. They benefit from the rent, they benefit from the capital growth over a period of time, and we'll talk about how that affects the tax position from a property investment perspective. On the flip side, property traders are all about turning it over. You buy a property to make a quick profit. So your intention is to buy it, sell it on, make a bit of cash, and then move on to the next property. So that can be anything from commercial, residential developments. We've got developments that focuses on that. That's very much property trading. Flips is the obvious one. And there are a bunch of other strategies that kind of fit within that trading model. Even when you talk about property strategies like sourcing properties and selling on a fee, you're providing a service, so it's more of a trading activity than it would be of any sort of investment activity. There are some significant benefits from a tax perspective of being classified as a property investor, so you're always going to have to make sure that you tick that box if you expect to get those benefits. So that's it, property investing and property trading, one of the most important distinctions. And let's talk a little bit about the different tax implications that can have depending on which side you fall on. Okay, so the first thing is, let's talk about your profits. What kind of tax you can pay. So assuming you're not investing through a limited company, if you're a property investor, you're going to be benefiting from the rent annually, so you're going to pay tax on your rent based on your rental income, and you've got all your tax deductible expenses there. We'll talk a little bit more about mortgage interest because that's a very specific topic, but generally you have your rent, you have the costs associated with that, be your agent, mortgage interest to a degree, insurance on the property, any maintenance, and then you come to profit and you pay tax on that. Pay income tax if you're investing as an individual, you pay corporate tax if you're investing as a company, but that's broadly speaking how you pay tax. You will also have a gain on the property in the year, so the value goes up year on year of those properties, but you're holding them and you don't have to pay any tax on that gain until you sell. Now, when you sell, that comes under a different type of taxation. It comes under capital gains tax. Now, again, if you're investing as an individual, you're going to have a capital gains tax personal allowance where you can make somewhere in the region of £12,500 a year without having to pay any tax. Now, that is separate to your personal allowance under income tax. It's a different type of tax, taxed separately, and the rates for capital gains are lower. So first of all, you get the benefit of this £12,500 a year exemption, so your first £12,500 of profit, tax-free, and then thereafter the rates are lower than income tax. So that's a real benefit from property investors. On the flip side, as a property trader, because your business is to buy and sell property, that isn't treated as a capital gain when you sell property. It's treated as income. It's how you make your money, therefore it's income. And if you're not investing through a company, i.e. you're investing in your personal name, then what that's going to mean is you have to pay income tax on it. And for people who already have a job or maybe doing a flip on the side, that has a significant impact. You might already be on the higher rate of tax, so you're already paying 40% on your income. Now, immediately that entire profit that you've made on that trading activity is going to be taxed at 40%. Massive hit. Not only that, because it's income, it's also subject to national insurance. So it's a huge hit, and so many people go into property trading, thinking that they can classify for capital gains and take the benefit of that. But if your business is just churning over property, buying and selling, flipping, then ultimately, you know, it's income and it has serious tax effects. Versus a property investor whose aim isn't to sell property, but you may do it every so often because, you know, the asset isn't performing or it's a bad area and you can't get a good tenant. You may say I'm going to sell it because I can get a good price. So we do that. We do that as property investors, and we make a gain. You get the benefit of capital gains tax and the tax regime there. So an important distinction. We've met a lot of people who have got themselves into a sticky position because they've done 3 or 4 flips. And their accountant says, look, now you can't justify you're a property investor here, you can't take the benefit of capital gains allowances because it's very clear your activity is flipping property, in which case you're going to have to pay income tax and it has a serious impact and a lot of your profits can be gone quite quickly. So that's one of the first things to know. You know, if you are investing through a company, whether it's property investment or property trading, you are going to still pay the same level of taxes. 19% of corporate tax, however they are taxed separately. So we do always say to people, if you're doing a bit of both, if you're doing a bit of investment, a bit of trade, try and keep them in separate entities. Usually your lenders will want to see that property investing is done in an SPV, so a special purpose vehicle, a company that is only used for property investment activities, not for other activities like flipping, etc. VAT registration, trading activities could lead in, generally residential property is exempt from VAT, however certain trading activities could lead to a VAT position. So certainly if you're doing commercial or residential and you're buying a commercial property with the aim to turn it into residential, that's a trading activity, and it's one that could lead to the requirement to VAT register because you're buying a commercial property, it may have VAT added to the top and you may want to claim that back, in which case then you have to VAT register to do that. So that's something to be aware of, that trading is more likely to have VAT implications. You know, certainly if you're doing a service type activity within property like sourcing, you know, if you reach the VAT threshold, which is I think around 80,000 in the year, you're going to have to VAT register at that point. And because you generally can't charge your clients more, what you're going to find is that VAT just comes off the top. So, you know, again, it has those implications. Property investment doesn't. Residential property rental is exempt from VAT, so you're not going to be able to pay any. You're not going to have to pay any VAT. It's at 0%. You're not charging it, and you're not able to VAT register through that type of company. Serviced accommodation is one to watch out for because it kind of goes between the two. You know, we have some HMOs that aren't serviced that classify as property investing. If you start to fully furnish them, if you start to fully service them, where you provide cleaning activities, whether you provide, you know, you pay the utilities, you pay the council tax, and they are essentially just renting a room, it can get quite quickly to a point where that's serviced accommodation. And if you have rentals within that serviced accommodation of more than 80,000 in a year, then again you're going to have to VAT register. And what that means is, again, you're just losing the money off the top because you don't get it. You can't charge a client an extra 20% more. There's a market rent for that property, so it's just going to come straight off the top, straight off your profits. So it's something to be, you know, more mindful of, especially if you're doing serviced accommodation on a large scale. Stock versus assets. So if you are a property investor, then the property is an asset, something you intend to hold for the long term. If you're a property trader, then stock, it's stock. Property trading, property becomes stock because again you're just holding it for the short term with the intention of selling it on. The important distinction is stock is always valued at the lowest value. It'll be valued at what you paid for it or what it's worth, the lower of. Whereas an asset is always valued at the highest level. It can be revalued at fair market value if you choose to do so. So, you know, there's an accounting distinction there that can have effects at least on your accounts, if not tax. Taxes on purchases, they're broadly the same. The only thing to be aware of, as I said before, with property trading is you might find yourself in a situation where if you're buying a commercial property, for instance with a commercial residential strategy, then you may have to pay VAT on that, whereas VAT doesn't apply on a residential property. So LBTT, ADS, any stamp duties that are applicable to purchase of a property, you're going to have to pay them whether you're trading or whether you are investing. That doesn't change. Use of losses between businesses. So if you're doing a bit of property investing, a bit of property trading, you lose money in one business, make money in the others, you can't offset those losses. That's not allowed. So there is a separation between the two types of activities for the purposes of sharing losses. Generally, within a group, if it's all trading activities, you can share losses between companies. That's not possible between property investment and trading, so something else to be aware of. And lastly, let's talk about Section 24. So most of you will know this already, big one within property investment. Section 24 effectively limits the amount of mortgage interest you can deduct as a property investor when coming to your taxable profits. Now, that's capped at 20%. So if you're already a property investor that pays income tax at a higher rate level, and your properties are owned in your own name, not through a limited company, then you're going to be paying a lot more tax than you would have before Section 24. So that's the big impact of that. The important point for this is that only applies to property investment, it doesn't apply to property trading. So if you are paying a mortgage whilst you're holding property in the short term, or any costs associated with financing, whether it's a bridge, mortgage, etc., those costs are tax deductible in full for property investors, not for property traders. So again, an important distinction between the two. So it's important to understand which one you fall into when you're investing, and the reality is, whether you want to be a property trader or investor, there is a way that HMRC look at it where they will make a decision for you ultimately when they're reviewing it. So, you know, they're going to be looking at things like, what was your original intention? Can you prove that you intended to hold the property for the long term? You know, you get instances where, say, someone's bought a property for their child who's going to university and intended to hold that property for the long term as an investment. However, the child dropped out of university in the first year and they've just decided to sell it. You know, short term, they've sold the property. It could look like trading, it could look like a flip, it could look like something that is property trading. However, if you can prove the original intent was to hold it for longer term, then you can classify that potentially as property investing. So they're looking at things like, what was your original intent, how long have you held the property, and you know, things like you know, ultimately whether or not you had added significant value to the property. So, you know, there's a variety of things that HMRC are going to look at when they want to make a decision over whether you're property investing or trading. So it's an important thing to draw a distinction on. It will usually be pretty obvious to you from the outset what your intentions were, and that's going to lead ultimately towards a distinction. So have a think about that when you're looking at property investment, especially when you're assessing how you're going to do that investment. You know, a lot of the time when it comes to property trading, the most sensible solution is to do it through a company. But you know, that's something that you have to weigh up in the whole scheme of your personal circumstances. So, you know, these things can still be quite personal, still get professional advice. But yeah, property investing, property trading, an important distinction when we're talking about property tax. I've been Alex Robertson, thanks for listening.